Welcome back, guys, and let's jump into one of my favorite topics, effectively structuring your active real estate. If you've been with us so far, you've learned a little bit about legal and tax entity structuring, you've learned about passive and active income, and you've even ran through some examples of how to structure your passive entities and your real estate investments. Now we're gonna talk about some of that active work and how we optimally structure that for tax purposes. As a quick refresher, when we talk about real estate, what real estate investments are real estate rentals, buy and holds. They're long-term, short-term, mid-term rentals. Those are investments, and those are passive entities, passive activities and passive income. That's not what we're talking about here. If you need more info on that, jump back to the last video and watch our structuring for passive income and passive activities. What we're talking about here is your active real estate work. We're talking about your property management, your wholesaling, your flipping income. And honestly, this all even applies to your non-real estate active. So if you have a separate business doing anything else, junk removal, landscaping, lawn care, this likely applies to that business. We've said it before, but remember, active income has a few different layers of income taxes. You're gonna pay your federal income tax of 0 to 37%. You're gonna pay your state income taxes of 0 to 14%, and you're potentially going to pay self-employment taxes of another 15.3%. So what do you do to reduce this tax burden on your active work? Well, I'm gonna tell you first off, the goal of this active business is to make money. Even if you have real estate investments, we need some money coming. I know there's people out there that say you can do this all with none of your own money, and that's great. But in my opinion, I wanna see some cash, I wanna see some money, whether that's through a W-2 or another active business. And what I'm talking about here is an active business. So your first step, and the most common example, is gonna be to go out and get your LLC set up with a qualified attorney. Once you have that set up, you're then going to monitor that LLC, and hopefully you're working with an accountant that's helping you do that. Now, at a certain point, hopefully that LLC business is going to be successful. And there's a point of success you can reach where it's going to make sense to convert this LLC from a disregarded entity or a partnership into an S corporation or possibly a C corporation. But right now, let's stick with the S corporation model. So now, what is the ultimate benefit of an S corporation? Well, ultimately, the benefit is that an S corporation does not pay any self-employment taxes. So if you are going along earning income in your LLC disregarded entity or your LLC partnership, and you were paying federal income taxes, and you were paying state income taxes, and you were paying an additional 15.3% self-employment tax, you are very likely over 25% of an average tax rate. But once you move to an S corporation, you have now wiped out one of those layers of tax. There is no longer self-employment taxes on that active income that you're earning. So what's the catch here? Well, the catch is that you have to do a little bit extra once you're an S corporation. You need to look into your state tax laws and make sure what those extra tax hits might be to having an S corporation. There's not a ton, but some states do have those. In addition, once you're an S corporation, the IRS is going to require that you take a salary if you're working in that company. They are now considering you the owner and the employee. And that salary has to be what they call reasonable compensation. You need to take enough that the IRS is content with how much you're taking as a salary. What would be the benefit to not taking enough of a salary out of that company? Well, let's take a step back and think about the taxes that are going to come on your salary. You're gonna have your income taxes, you're going to have your state taxes, and just like a W-2 job, you're gonna have FICA taxes, Social Security and Medicare taxes. You're gonna pay 6.2 for Social Security, you're gonna pay 1.5 for Medicare, so ultimately you pay 765 as the employee, and guess what? You're also the employer, so you're paying 765, and you're right back to that 15.3% rate. What that means is whatever amount you set as your salary, you're still ultimately paying that 15.3% tax, just paying it through FICA taxes. But everything else that you earn through the business that's not your salary, that's now free and clear of any self-employment taxes, and you're only getting taxed on income taxes at the federal and state level. Now, I know as we get into S corporation structuring, this gets quickly complex, and I think it's easiest understood with an example. So let's assume you've started a business and now you've had some success. You're the sole owner of this business and you set up the LLC, but you didn't do anything else tax-wise, so it's a disregarded entity. And this year, you're going to earn a net taxable income amount of $100,000. On that $100,000, you're gonna pay your federal taxes, your state taxes, and your self-employment taxes. If we're being conservative and saying you have an average tax rate of 10% federally, and we're taking into account the qualified business income deduction that's available in 2024, you're probably gonna pay federal taxes around $8,000. You're gonna end up paying state taxes around $4,000 to $5,000, and you're gonna pay self-employment taxes of $15,000. Or put another way, on that $100,000 of taxable income, you have a 28% average tax rate. So let's assume now instead that you convert that LLC into an S corporation. You're going to need your accountant to file an S corp election, whether that's on time or a late retroactive election. You're going to need to get payroll set up so you can take a salary. So there's some additional guidance, there's some additional things that come up when we're talking about the S corps, and you need to be aware of that when we talk about when it makes sense to go there. Coming back to our example, if you now earn $100,000 of taxable income through that LLC S corp, here's how things are going to work. You're going to take a salary, and let's just say roughly that reasonable compensation comes out to $40,000. So on $40,000, that's set up as payroll. It gets withdrawn from the business, the taxes are paid in for the employer, and they're withheld from you as the employee, and the net amount goes to you personally. So the business is now down to about $60,000 and just under when we talk about payroll taxes. But we'll say it's $60,000 of net taxable income. So let's figure out what your total tax implications would be in this situation. You've got $100,000 total earned, but what happened was you took $40,000 as a salary. So now we've got $60,000 in business earnings and $40,000 as your W-2 wages. Federal taxes, you're gonna pay about $9,000 on that. In state taxes, you're gonna pay another $5,000 on that. So total federal and state taxes, you're gonna pay $14,000. But guess what's gone? The self-employment tax. That large $15,300 is gone. So we went from $28,000 down to $14,000. But let's be real here and talk about what actually happened, because in so many TikTok videos, you'll find they won't go into this piece of the S corporation. On that $40,000 salary that you had, yeah, you have no self-employment taxes, but you still pay FICA taxes. You still have Social Security and Medicare withheld. You're the employer, so you're still paying both parts in. So on $40,000, you're still paying 15.3%. And you're also paying a little bit extra in unemployment taxes as the employer. Well, even taking that into account in this situation, you'd be at another $6,000, $6,500 roughly in taxes, bringing you up to a total tax bill of about $20,000. As we compare this to our initial example where you paid $28,000 in taxes, from moving to an S corp, you've saved $8,000 a year in taxes. If we compare this to our initial situation where you did not have the S corp and you paid $28,000 in tax, we've just saved $8,000 total from moving to an S corp. In addition, you've probably had to pay out a little bit more for this. You've had to pay a payroll company to run payroll. You've had to pay your accountant to do the whole setup, and you've had to pay your accountant for a separate tax return if this was an individually owned company. So you've probably paid another $3,000 to $5,000 to the accountant this year. Now you're at a savings of around $3,000 to $4,000 in taxes per year. So does that make sense for you to become an S corporation? For most people at this time, it does. When they start to get to that $75,000 to $100,000 of income level on their business, they start to think about converting to an S corporation. At times, it can make sense well before that. It's situation dependent. It's dependent upon each person's situation. So my personal advice here is that whenever you realize that the self-employment tax savings that you're gonna get here is going to outweigh the additional fees that you're gonna pay to an accountant for the setup and to the accountant for the tax return and to the payroll company, that's when it's time to convert to S corporation. That can be different for everyone, but I'd say once that bottom line gets to be 40 to 50K or above, start having the conversation with your accountant so that you guys are on the same page and know that you're ready when to pull the trigger. Now let's say we move into year 2 in this example, and you went from $100,000 in taxable income to $150,000 because the business is growing, right? Well, guess what? On that additional $50,000 that you just earned, you saved your 15.3% tax. You've already set your salary at $40,000. You don't have to bump up your salary just because you made more money. So the more money your business makes from this point forward, the more tax savings you have. That's why it will make sense so long as your business reaches a threshold and you know, or you can bet on yourself, that your business is going to make at least that amount or more each year thereafter. Now you can reach a point in time where it could make sense to go to an LLC C corporation instead of an S corporation. What I've found with most small businesses and active real estate businesses is that doesn't happen too frequently. So for the sake of this video, we're not gonna dive into the world of C corporations, but maybe we'll do that in a future video. The main thing that I want you to take away from this video about structuring your active real estate income, as well as our prior video on structuring your passive real estate income, is that your active income should be set up in its own LLC. And when it's time, that possibly should be converted to an S corporation. Your real estate rentals should be set up in separate LLCs. And those LLCs that hold your rental real estate investments will never become S corporations or C corporations. Guys, thanks for watching. Please be sure to subscribe and catch the last few videos in our series here on the foundations of real estate tax planning. Allow you to build your portfolio that much faster, because that's our goal here, guys. It's not tax savings for the sake of tax savings. It's not accelerating your cash for the sake of just just keeping that cash. It's going to allow you to save taxes and then put that money to work for you so that you can build your wealth that much faster. Increase your portfolio. Get that down payment for the next property. Buy the next flip that you want, right? Because these types of strategies can save you tens to hundreds of thousands of dollars in taxes every single year. And that's money that you can use to build that portfolio and to leave behind to the generations thereafter. Thanks for watching, guys. Until next time.